Welcome to our eSignal weekly Forex forecast. My name is Jay Norris. I'm a trading instructor at Trading University. And as always, we need to remind you that trading involves risk of loss and is not suitable for all investors. First market we're going to take a look at will be the Australian US dollar. Yeah, the Aussie remains on a positive setting. You had a pretty steep correction throughout much of last week, but it ended up closing stronger come Thursday and then held those gains into weekend. So Aussie on a positive footing now. If I go to our RTT ratio, what I refer to as the brains of the operation, and I'm not kidding, I rely on this quite a bit. You can see all those short-term patterns are back bullish, and it's impossible to be a short-term trader and buck these short-term trends. So for our money, we're definitely more interested in buying dips than not in the Australian dollar. So Aussie, we're in the bull camp there. Next market, the dollar Swiss. Nothing but downside from our perspective. Even you peel out to a weekly, and you can see there's a lot of room down below. 85, really the big number down there. Now, you know, if we tighten it up here, pan out a little bit, the one enemy to those of us in the bear camp is going to be the Swiss bank, the Swiss central bank. These are levels that they've been tolerating, but I think the cheaper you get, the more likely it is that they'll try to step in and intervene to prop prices up and knock the Swissy down, prop the dollar up against the Swissy. So here's a little shelf right there back from 2011. You had a heck of a bounce off there, so that would be naturally be a profit target for I guess intermediate term shorts. So we'll have to see if they press it all the way to 85. But keep in mind, the cheaper you get here, the more likely that you'll see intervention on behalf of the Swiss central bank. Next market, let's take a look at the dollar index. I see we still have that box painted on there. Essentially, I was highlighting that sideways range that you've been in. And, this support, that's basically a 50% retracement of this long-term primary pattern. You can see good support at 79 even across the board going back for years now. We don't see anything changing. From a trader's perspective, yeah, you want to work the short side, short and intermediate term. But as a longer-term trader, looking out years, you have to realize you're coming up on support here in the dollar index. And that's significant. Long-term support, it's only relevant when you get on top of it. So when I peel down to a daily chart here, you can see, well, you probably still have a little bit of room to go down there. So you're mindful of that as a shorter-term trader. But, the closer you get to that 79, the figure, the more support down there we would expect. Next market, the euro. The mirror opposite there. The euro is pretty interesting. If I pan out to a weekly chart, you see you're right on top of significant long-term structure resistance. There's our RTT level. That level means as long as price stays below there on a closing basis, that long-term primary pattern is still bearish. So as I said before, the only time long-term structure resistance in this case is relevant is when you're right on top of it. So you are right on top of it. So we're aware this is a significant area, and this is actually an area where we might start sniffing around, fishing around for a potential counter trend sell signals, albeit short term. And it just so happens because of that long wick, you actually shifted your 5-day pattern bearish right in here. And it's not that significant. It's a 5-day pattern. You still have a pattern of higher lows, higher lows, higher lows. But you did shift that short-term stuff, that 3 and that 5. And as long as you remain below that RTT level right there, I'm not sure, is that a 625 or what is it? Probably a little, yeah, it's 625, so it's not an RTT level. But at any rate, you have resistance there on a closing basis. So you have a potential low or high. So short-term traders will keep an eye on that because you have that long-term resistance right there. That's 2.5, 3 year resistance right there. Now if you set up a lower high, counter trend traders may go to work here. But for my money, I'd really like to see a lower low in here. Take out this low, or at very least take out that low to break that pattern, break that bullish pattern of higher lows and higher highs. So maybe something to watch. The one point I want to make is that you are at significant long-term resistance, and we say it time and time again. The only time long-term resistance is really relevant is when you're on top of it, and you're on top of it now. So keep an eye on that 139.50, 55 level. And of course, just beyond that, backing that up, is that significant psychological point of 140. There's a lot going on in the euro. Hey, here's the gold chart for you. I'm in the bull camp. I'm in the bull camp. You took out this resistance with authority there. So I'm definitely interested in buying dips in the gold. I think when you pan out the weekly chart, you got a pretty decent long-term upside target of 115. I'm sorry, 1500. So 1500 on the upside in the gold, what we'd be looking for. On a shorter term basis, we're definitely interested in buying dips. So gold shifts into the bull camp. Here, I'll show you the RTT ratio on old Goldie. There you go. I think it's actually a short-term secondary pattern. You shifted higher, and this would be a long-term secondary pattern that's still down. But significant, you shifted that short-term secondary pattern higher in the gold. The bottom line, all these short-term patterns are higher. And, you know, again, this long-term stuff, resistance, it's a long-term resistance level up here in the gold, just below 1500 that I'm keying off of. That's really not relevant until you get to it. So for our perspective, for our money, you know, there's a lot of room up above in the gold market. Looking good. The world's oldest currency, gold, looking good. Dollar yen really kind of a yo-yo there. It stopped at right at a 625. So you retrace this move, 625, pretty predictable level. Now you came down hard. We'll have to see, you know, if we still like it at that 101. We'll have to see if, you know, what at the, you know, our dynamic analysis at the time tells us static, you know, from a static perspective, you know, we'll look at 101 for a potential double bottom, but, you know, the momentum's coming down pretty hard here. You shifted a lot of patterns all at once there. You're 5, 10, and 25. So pretty bearish looking, but you have to respect 101. But, you know what, if I like it at 101, I love looking for a potential setup, looking for a potential support to hold at par. So, you know, par may be in the cards, but you got to look at it. It's got to get through 101 before we can check out par. So shorter term, you'd be on the short side here. A little bit intermediate term, longer term, we're interested in 101 and probably realistically more par, looking at par. Hey, thank you so much for coming and checking us out here. I'll leave you with this thought. One of my earlier mentors and just a great man, a great trader, great investor too. Here's what Bill Williams, my old friends, used to say, or still says about the markets. All we need from the market is for it to provide us signals so we can take the appropriate action, and that's so key for what we teach at Trading University, and that is to focus on the market and let the market guide us and tell us what to do. Thank you so much, and we'll catch you next time. Bye now.